Position. He already heard what other speakers mentioned, and that was my initial idea, to have a sort of second round. Very short, please. Very brief comments, not more than 2 minutes, whether you agree or not with what others said, and your also very short outlook for the dollar, euro, pound, whatever currency, volatility trends for this year. Do we see any trend only this year? I'm not talking about long term. Maybe we start with Nassim.
Okay. One thing, again, I'm going to report on what I did during that unit of time between two Troika Dialog meetings, all right? So, after leaving here, I heard about governments getting involved. It makes me scared, and I saw where's it going to mess up, okay? And what mistake I was going to make. And I realized that all the economic, not almost all the economic papers that deal with monetary policy don't know about what I call fat tails. Fat tails is massive errors of estimation of what I call non-Gaussian, a class of distribution that they use is not the class of distribution that exists in the real world, but they don't know it. And incidentally, they still teach the same old junk in schools, all right? So anyway, so I realized what is the consequence of their not understanding it in monetary policy. And it's going to be as follows. The problem of nonlinearities, they don't understand nonlinearities, is that they still think that, you know what, you can print a little, that produces no inflation. Print a little, produces no inflation. And then guess what? Then you print a little, and guess what you get? Hyperinflation. You see? The problem is like the ketchup bottle. Nothing comes out, nothing comes out, nothing comes out, and then you have ketchup all over the table. All right? That kind of environment. And we know nothing about the dynamics of when all that ketchup is going to come out. So they have the illusion of no danger, no danger, no danger, just like what happened with debt, okay? So that's nonlinearity. And it's very vicious. So this is one problem that government don't understand. This is why my bets now are on two things. Either we're going to have no remedy to the crises, okay? And massive collapse of asset values because, you know, of what can happen. That's the first leg. Or hyperinflation, or as I think we're going to have both. Because it's so delicate, and the analogy I used is a plane trying to land on a narrow runway to get monetary policy right. That's what, this is why trusting Bernanke was that. It's like trusting a child with dynamite sticks, alright? Is, if you land that plane on a narrow runway, if you overshoot, you go into the mountain, which is hyperinflation. If you undershoot, you go into non-effective policy at all, you fall into the water, and that's a problem.
Thank you. And we go in this order, maybe Martin, not more than 2 minutes, because we have to also.
Just a quick observation following from that remark. I'm not quite sure how we get to where we're going to be going to get to this hyperinflation or massive default. Because it seems to me that one of the immediate, relatively short-term problems with an American election coming up this year and the pressures that we were already seeing in recent days from the U.S. to try to pressure the Chinese and other managed currency countries to move on their exchange rates is a likely increase in protectionism and trade friction and financial friction in the world. And the G20 framework is not going to help resolve that. That I can see that with increasing reluctance for anybody, as Nouriel was pointing out, everybody wants to make their currency export competitive. Nobody wants to appreciate their own currency. They want someone else to do it. And it's not going to be happening. And this stalemate cannot continue forever. It will not help the world to adjust. And how this will happen is likely to be very political and even possibly a little bit dangerous, as some scenarios would suggest. Thank you.
Actually, my forecast for the near term, that is the next 5 minutes, is for dollar strength. And let me explain you why I think that the dollar will go up in the near term and why it will go down in the long run. 2002 to 2007, all asset prices go up. In other words, real estate globally, equities globally, commodity prices, and even bond prices. In other words, interest rates continue to go down, and art prices and collectibles. Only one asset class goes down, the US dollar. And this was a period, 2002 to 2007, where global liquidity expands at an accelerating rate. And then comes 2008 and everything collapses, but one asset class goes up, is the US dollar. And then we come to important turning points, end of 2008. The bond market peaks out on December 18th with the 10 years yield at 2.08%. December 28th, oil prices bottom out with oil at $32 per barrel. And then end of February, the dollar peaks out, end of February 2009. And then March 6th, the S&P bottoms out at 666. And then everything goes up again, but the dollar goes down. And now I believe that we have dollar strength because money supply growth in the US and money supply growth, especially in China, has decelerated meaningfully. Dollar strength is a symptom of tightening global liquidity, and so that may last for a while, but once Mr. Bernanke and other central bankers will notice that there is again tightening liquidity and a decline in asset prices that will accompany this tightening of liquidity. Say the S&P drops from 1150 to 900. They'll print again, and then it will lead again to renewed dollar weakness. So for the next 3 months, I think the dollar is okay. Thereafter, we'll have to revisit the issue.
Thank you. Professor Phelps, just 1, 2 minutes, not more. Thank you.
Good. That's about all I have. This has been tough, but I've managed to retain a modicum of optimism that the world can get through this crisis without some sort of a monetary breakdown in which we are all seeking real assets and unwilling to hold paper currencies. I think that there will be enormous political pressures on the Fed to tighten, not just once more episodically, but to tighten for good and for real. If it should become clear at some point that inflation has gone to something like 3%, and it looks like it's staying there and maybe even going to go higher. Once something like that is clear, then there will be enormous pressures on Washington to tighten. I know there will be also pressures for price controls and a lot of stuff that won't help in the long run, but I think there will be pressures to tighten on the monetary policy front, and that's the crucial one, I think, for getting control of the price level. And if that can be done, then the dollar, while it will be seriously weakened, won't be in a bottomless pit. It will stabilize somewhere, and gradually we'll pull ourselves out of this secondary crisis. At least that's my hope.
Thank you.
Just let me give you some insight into what I found out is sort of Chinese central bank thinking at the moment. They're probably one of the few central banks in the world that realize that before long they're going to have to be appreciating their currency, if only to blunt the increasing inflation that's going to exist in the global economy. And they're probably going to do it sometime in the middle of this year. They won't do it by much, but they do realize they will appreciate their currency. In that process, they are going to lose money on their FX reserves, which is why they're diversifying not principally into other foreign exchange reserves, but actually into real assets, to pick up on an earlier point. Their investment in Africa last year made them the largest investor in Africa, ahead of the World Bank and the IMF combined. They put about 500 billion net into Africa over the last 3 years. That they put twice as much into Latin America and pretty much the same as Latin America into Australia. The result is that they are not diversifying into the fiat money that Marc fears so much, and rightly so. They are diversifying into real assets. And one of the things they realize is that although they will make a loss on their foreign exchange reserves, their $2.4 trillion, the appreciation that they will make on other assets they've now diversified into will more than make up for the loss that they make on the cash holdings that they have in their foreign exchange reserves. So the world looks very different from Beijing than it does perhaps if we're trying to think about the world as it were. And this is part of the problem, is that people think so much in dollars that they can only think in dollars when thinking about Beijing's predicament. Beijing does not think in dollars. Beijing thinks in renminbi.
Thank you. Michael Wexler, just 1 minute.
I've been reduced to 1 minute.
1.5.
Maybe I created a little bit more bullishness than before. Actually, maybe a suggestion along the lines of your comment is to rename the dollar to start with an R. Maybe if it was the roller, it might come roaring back. The dollar is here to stay because there's no alternative and nothing that has the size or depth or liquidity. There's 70% of the money running around the world is in dollars, and you can't just change that. You can't just change that game. Over the last 500 years, there have been several different reserve currencies. It doesn't last forever, going back to Dutch, Portuguese, Spanish, French, and sterling. Typically, a reserve currency goes for anywhere from 50 to 150 years, with an average of about 80. The dollar's somewhere right in the middle of that range now, so maybe it's had an average duration, maybe it's its time, but it could also take another 30 or 40 years until maybe the renminbi is ready to be the one or some other creation of the world's device.
So thank you. For this year, you think we can stay with the dollar, and also, as Marc Faber said, 3 months for the dollar is okay. And then maybe we have some time for Q&A. If you have someone who have questions, please to microphone. Who can help us? Yeah, those who want to ask questions, please go to the microphone.
Okay. Hello. My question will be to Marc Faber. It's an interesting view that dollar will devalue in the next 10 years. And as you said, if you want to save your wealth, you need to invest in equities, gold, or real estate. But this is a strategy for individuals. From a government point of view, Russia has a massive gold reserves, which are basically proceedings from sale of oil. Or, for example, China has a massive gold reserves. From their point of view, what do you think? What will be the best strategy to save nation's wealth?
Well, I think it's a very good question. If you are an oil producer or resource producer, such as the Middle East, Central Asia, Russia, what do? Do you sell your materials, say oil, and get dollars and other paper currencies, or you keep it in the ground? If I were running Russia, I would keep it in the ground, but I would make sure nobody can steal it. That is an issue. But for sure, I can tell you, because I look at commodity cycles and so forth. We had a bear market in commodities 1980 to 2001. And then we had a rise in commodity prices, but inflation adjusted, they're still low. And the supply response didn't kick in because as people began to look for new mines and new oil deposits in 2005, 2006, came the financial crisis of 2008, and then no financing was available. So in general, I would say that actually, if someone believes in a global economic expansion, sometimes in future, maybe your grandchildren, then resource prices will be much higher. So I would keep it in the ground to answer your question.
Thank you.
Thank you. Number 3, microphone.
I wonder if any of the panelists would like to share their thoughts on the sterling, given that the UK is obviously an economy facing serious structural problems and questionable competitiveness, but also the sterling is a currency that arguably is attractively valued at the moment.